Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets. As always, don't use these for trading. They are for information purposes only. I always begin here with a weekly chart of the S&P 500. Put up some support and resistance lines here as well. This goes back to about 2018 here all the way on the left side, and you can see the big rally that we had post-COVID as all the money flowed in from the government, and then the bear market that we had here in 2022 as interest rates started to increase to try to fend off inflation. And now we had actually been in a bit of a sideways here for about a year as it went back and forth between these two levels as the market tried to figure out what's happening. And now we're actually getting back into a rally mode as the weekly chart has turned. It's definitely not in sideways mode. It's in uptrend right now, despite all the talk that we hear about recession happening this year, that kind of thing. The markets are telling us right now that they're rallying away. We try to basically just pay attention to what these charts are saying, and that's what we're hearing at the moment. If we go down here and look at a little more detail, this is the daily chart of the S&P 500. This will give us about the last 2 years trading. And you can see here we've been in an uptrend in the market since basically mid-March as it's rallying away. Definitely having a little bit of a down day today, but that's going to happen from time to time. These aren't going to be just straight up and straight down measures, but everything on the weekly chart and the daily chart is still in rally mode. So remain pretty well invested for the time being. If we go and look in a little more detail, you can see here this is a 2-hour chart. Each of these is about 2 hours trading. And this gives us a good look at the last 6 months trading in the markets. And I've highlighted the channel that's going up here. As you can see, we just keep working our way through it as it grinds higher. Certainly, if it does break and come lower, we're going to be taking risk off. But for now, everything that we're looking at is going higher. If we look here at some of our internal measures, what we call the breadth of the market, this is the percentage of the S&P 500 that's in an uptrend, and currently it's 68% here, which isn't a really high number. Normally in a big bullish rally, we'd want to see maybe 90%, somewhere around there, but it's still a decent number. We're 2/3 of the stocks in the S&P 500 in an uptrend, so that's good. And you can see by comparison, if we come back here to March, where the market was selling off and then bottomed, we were down to about 25% there. This next one is the advanced decline line on the New York Stock Exchange. And see, it's rising a little bit. It's not overwhelmingly strong, but it's definitely on the rise, even as it's coming back the last couple of days. But I'd say that's generally positive. And the bottom one here is the VIX, the volatility index. This gives us a measure of the fear in the market. They call it the fear index. Right now, it's pretty low. So the three of these, I would say there's nothing to really concern myself with or ourselves with in terms of the breadth department. And the market just continues to rally away a bit. And we'll keep our eye on that. One of the things that is concerning here, this is the interest rate on the 10-year U.S. Treasury bond. And you can see that during the COVID time that it got down to about 0.5%. That's what this would be down here. We're now looking at breaking north of 4%. And that's really probably a lot of the reasons why the market had been selling off in the prior time. If we come back here and look what was happening here in 22, that's really as we started to see interest rates move higher, that's what that did to the stock market. So still a little bit of a cause for concern that inflation's not dead. The Fed won't stop increasing interest rates, and if they do and we break out much higher here, I wouldn't be surprised to see the markets react. But again, we just pay attention to what they are doing and not try to predict or have a crystal ball about it. As far as the economy itself, we come over here to Trading Economics, great site for some data. You see here the annual growth rate on U.S. GDP. The last two readings both positive, and in fact the last one's even better. So we're still getting a good growth rate out of the economy. Same with non-farm payrolls. The jobs number right here, both good numbers. We're still in positive territory. And then we have the retail sales month over month. Again, both positive. So nothing to see here yet. sure we could have a recession. People keep talking about that, but the data is not there yet, and the markets certainly aren't telling us that that's where they're heading. So we're going to remain invested for what we see, not what the crystal ball says. And if we come over here to Y charts, give us the numbers for the forward estimates for the S&P 500. And this is what they poll the analysts involved in this and in predicting forward earnings and saying, okay, what are we going to do here? And as you can see, it's very positive what they're looking for on the S&P 500. Very good numbers going forward. So for the time being, nothing to really be too concerned about. Come back here to the weekly chart. You see that in the uptrend. So remain invested for the time being. Certainly want to watch this. If we broke down through this level and this just became a little bit of a head fake, that'd be a bit of a concern. But for right now, everything is telling us that we're still looking pretty good there. So anyway, I hope this was helpful and informative, and certainly reach out if anyone has any questions about how we're managing portfolios. And otherwise, as I said, hope it was helpful, and we'll see you at the next update. Thanks so much.